always actually a very big fan of the program, so definitely echo your words, Raj. I think, hopefully you'll see also a lot of impact from having participated. Maybe I'll start by giving just a quick, super brief intro. I have some slides I prepared, but if you're anything like me, no one really likes to sit through slides. So I'll quickly go through them just to give you a bit of context when it comes to the infrastructure of the ecosystem. And then we'll move through to your questions because I think that's much more exciting. So super brief, let me share my screen. Let me see. Okay. Perfect. Can you see my screen?
Yes.
All right. Is it in full screen mode for you guys?
No.
Okay.
I think because you're sharing the application window, so when
Okay.
you open full screen, it opens another window.
Yeah. Once.
Drive safe, ربيعات.
Sorry about this, guys. It's just a
No
minor
problem.
interruption. The perks of working from home, which I decided to do after all because the traffic in Dubai is better in the morning, but if anyone's experienced it in the afternoon, it's still really, really bad.
Yeah. I think also it's the season where everyone is like traveling nowadays to Dubai.
You know, unfortunately, that's true. Okay. Okay. Do we have it now?
Yes, cleared.
Perfect.
Yeah.
Okay. So super quick brief about us, just so you have an idea, who we are and who's talking to you today. So my name is Stephanie. I'm a partner at NUA. Our firm's about 4 years old, but we've been in this space for about 17 years, my partners and I. These are my partners. I think we have a great kind of team culture. We have similar but different enough backgrounds that our skill sets are quite complementary, which, fundamentally is also what we like to see in startups. Khalid, our managing partner, was also the managing partner at WAMDA, where him, Sara, and I met and overlapped, and also for a short period of time with Nitin before we effectively graduated from WAMDA and launched our firm in 2020. So we've been in the tech/VC space for a very long time, all of it covering MENA, Turkey, and so MENA, GCC effectively in Turkey. And we've invested, in some of the region's kind of biggest stories, I would say, whether by value or by brand equity. So some of them are from our previous, as a MarTech, an analytics company, if you guys are familiar with it, or from NUA in Kalo, Aywa, Silk House, Valio, Raqamiya, Irad, and so on and so forth. So let's talk a little bit about the ecosystem, where effectively you can't really time it, but there's a little bit of, we're really at an inflection point here. So I'm not going to bog you down like with the details. I think this is a very interesting market to build in. I'll just pause a little bit on this and tell you, part of our thesis is regional because of these metrics that you see in front of you. But what makes it very distinct to build a company in the region is that it's a very tough market to build in, because in aggregate, you have to build in aggregate. So you definitely have to, in most cases, have a regional view of things. And that requires almost rebuilding your business whenever you scale, right? Because hiring will look different, regulation will look different to some extent, and so on and so forth. So effectively it becomes quite difficult to build in the region, which is also great news, because no, it doesn't mean that anybody can do this. You really have to kind of roll up your sleeves, understand the different nuances when it comes to consumer behavior, when it comes to cultural, when it comes to reg. But effectively, this is also why very often, and that kind of traces historically the exit stories we've had, if you think about it, historically, that's also why most of the acquisitions we've heard of, at least, have been a global competitor acquiring the region's answer to what they do. And by that, I mean, as an example, Uber acquiring the region's answer to ride hailing, which is Careem, Amazon acquiring the region's answer to ride hailing, which is Souk, and then Yahoo acquiring very early on, and I don't know if any of you actually remember that, but Yahoo acquiring the region's answer to effectively AOL, which was Maktub, based out of Jordan. And that historically has been, you know, the design, I would say, of the exit landscape, where you have a global competitor that's acquiring the region's answer to what they do to gain footprint here, because, as we mentioned earlier, it's actually quite tricky to build here. Where we are in terms of ecosystem, when we started about 17 years ago, we were one of, when we started, and when I say that, I mean when we started our careers. So when I was at WAMDA was one of 3 early stage VCs. When we launched NUA, we were probably 25 to 30, and I'm not counting everybody. And granted, there's some consolidation that's happened since, and you'll see it in the numbers I'll share a little bit later. But the idea is, if you chart the path of our markets, and when I say markets, I mean the region as a whole, if you chart the path of our markets, and particularly Turkey, UAE, and Saudi, and you compare it to other emerging markets with similar dynamics, you can see that we're on a very interesting growth track. I don't love the idea of tracking things by unicorn, but it's just to get an understanding of the maturity of the ecosystem in terms of, does there exist enough infrastructure for companies to grow from very early stages to pre-Series B, Series B, both in terms of funding, in terms of regulation, in terms of talent, in terms of all these things that you guys need. And you can see that there's definitely an inflection point, and I would almost place that at a few years ago, maybe around 5 to 6 years ago. The reason I would place it there is threefold. I think there's lineage in the ecosystem. So there's people who have either exited previous companies or worked at companies before and have seen what it takes to build a business, scale a business, understand failure also, you know, are very well placed to launch and understand, obviously, the region, have some sort of you know, information leverage. Those people are launching their own companies, and the way they build a business is very different. Their profile has changed. I'll actually go to this slide, and then maybe I'll jump back. Their profile has changed. This is not your, you know, the stereotypical super young founder who doesn't necessarily have any or at least a lot of depth in a particular industry or a lot of work experience, who's launching a business because, you know, it sounds interesting, or I don't want, you know, I don't want a boss. This is someone who's got real life responsibilities, most likely, and we've tracked it in our portfolio. So typically between 30s, 40s, 50s, real life responsibilities. The way you raise money is different. The way you lead a team, the way you build a team, the way you hire, and you understand the liability that exists in that is very different. But on the capital side, a few things have happened as well. I think, whereas in the past, the way you built a VC fund or an investment vehicle was also different, I think today the profile is quite diverse. So you have more VC funds. The backers of the VC funds are more diverse. So let's say in around 2012, when you started having maybe the 2-3 VCs that existed, the backers were mostly maybe some, you know, IFC, EBRD, Crescent, so a few large institutionals or developmental money, and then a few high net worth individuals. Today, and I can tell you this very transparently, you know, from our experience at NUA, most of our investors are actually corporates and family offices, so it's private capital. And then we have a few sovereign wealth funds. So we have Jada, we have SBC, we have Dubai Future District Fund, we have Mubadala, which would be considered semi-governmental. But the majority of the capital is actually private. And I think this changes things quite a bit. Because they're investing for different reasons. So obviously everyone's always looking at generating capital, right? So upside will always be, very important, obviously. But particularly for the corporates and even the family offices, where at the backbone of which exists an operating business, there are different points in their own digitization. They sometimes want to digitize or want to understand, want to be exposed to technology, or they want to diversify the assets that they've been investing in. And so their behavior is very different. They'll often invest in a fund, and that's not just NUA. They'll invest in a fund, but they'll also like to invest directly, which is great because they have, it's great for two reasons. A, they have access to, they're closer to the technology, they're closer to the mindset of the founders. On the other side of that, and for the founder in particular, if this is a good partnership, right, which we all hope these investments partnerships are, you have access to their network. They will be some of your great brand ambassadors. They'll unlock potentially supply or unlock demand if they exist in adjacent industries. So all of this to say that this is a very exciting moment in the ecosystem. I'll leave the slides with one sort of thought to capture. We talk a lot about this being a very nascent ecosystem. It's only 17 years old. It's super young, but we have also a lot of kind of success stories that we get very excited about. It is very nascent in many ways, but one thing to keep in mind is that the rate of growth of this ecosystem, when it comes to the type of capital that exists, when it comes to the institutions that exist in the ecosystem that are helping build out this infrastructure, is not comparable. It's actually quite fast. So we are at an inflection point where things are going to mature very fast. And what this means, I'll give you an example. This means that, obviously, I think you've all seen it, right? There's a big push towards diversifying exit paths. So M&A has traditionally been the path of choice. And most of what we've heard about was like the global comps buying the regional companies. There's also a lot of regional M&A where you have the incumbent or sort of the old school business or a startup acquiring a younger startup or a smaller company. But obviously everything's being kind of pushed, and there's a big incentive on building value through listing of homegrown tech companies. And whereas in the past, I think we could mention, or even by last year, we could mention a few that had either gone public, like Jahez, obviously, or that were working on going public today. And we see it because we run different products as NUA. There is a robust pipeline of tech companies that are working on going public. And it might not be now because sometimes it's a few years in the making, but they're working on that. The other side of that coin is that because there's a lot of early stage funds, and here's why the need for diverse sources of capital is very important, and why you see some of these funds graduating into running different products is effectively sovereign wealth funds. I guess to say it super or to cover it really quickly, a lot of sovereign wealth funds have seeded a lot of early stage funds, right? Which have also raised from corporates and family offices and so on. But effectively what this did is, which is great, is de-risk early stage. So it hasn't become easy to raise capital, but it's become significantly easier than it was 8 years ago. At the same time, because of the type of talent that's running these businesses, the rate of graduation from early stages to early growth, which for us is growth in the region, so pre-B, Series B, and so on, is higher than it used to be, which means that you have more growth stage companies requiring larger rounds. And here's where it could get tricky, because historically it's taken sometimes on average 40 or so months to raise a Series B round. That's changing now because there's a lot of excitement, but that could be very destructive for a company. So there's a bit of a how do we cover growth stage now? Because you have very few players that can come and say, oh, I'll put $20 million into a deal. The reason why you have very few players is because it's still an early stage ecosystem. The firms themselves, like Nua, like others, are maturing. We also, obviously have to mature. We can't just continue to exist as early stage funds. And sometimes that's actually someone's mandate and portfolio, and that's how they view their portfolio construction. But the ecosystem as a whole, to have this kind of robust build out, you need different pools of capital, which is why having some of the family offices that are quite deep, having some of the corporates that are quite deep, and even institutional sometimes go direct, can be extremely powerful. So I'll stop here when it comes to the slides. So just to give you a little bit of a lay of the land. Obviously, I guess, Saudi is the growth market. And I'll even give you a bit more context as to why this mattered to us. So none of us at the partner level in Nua are Saudi. But for us, it was extremely important to not only just have the right partners in Saudi, but really grow roots there. So we spent quite a bit, not quite a bit, I think Wajdan and Mariam know this, but we spent a lot of time in Saudi, and it also feels like not enough. But we also have one person on the ground there, and sure, and that's great. On the investor side, our anchor investor is actually Al Faisaliya Group. And Al Faisaliya Group, we met them and built relationship over time. They were looking at getting exposure into VC. And then they met us as a team back then. It was Sarah, Khalid, and I, and we had this idea of how we wanted to build out the firm. And I think Mariam, you had shared this was like a question to understand, like, why would someone like this large conglomerate look at investing into VC? For them, they operate across different business sectors. They wanted to get exposure to VC through a fund, and they're also a partner of ours. So for multiple reasons, they could see that it could be very interesting when it comes to returns. So obviously upside is interesting, but at the same time, it's quite strategic for them because they operate across these different business sectors. So there's always benefits to be exposed to technologies where they can potentially unlock, and they have in the past actually unlock access to specific financial institutions for some companies in our portfolio, or use them for their own portfolio. So it's been very synergistic in that sense. So yeah, I'll end there and maybe jump into the questions if that's fine.
Definitely. So guys, if you have any question, please unmute yourself and ask it to Stephanie. Yes, Hidayat, go ahead.
Hi, thank you. Thanks for the presentation and all the information. My question is, since you've seen the shift and the huge, let's say, number of startups that are coming into the Saudi market, what is Nawa's strategy for foreign companies coming into the Saudi market, and how do you guys, what is the perfect way to say this is a potential company to come into Saudi and we would like to invest in them?
That's an excellent question, actually. And I think it applies particularly now to Saudi, but it applies generally to the region. So we do end up being at the receiving end of a lot of opportunities that are still outside of the region. And there's two ways we could address this. Typically for us, we like to have comfort in the fact that this company is two things, right? Is not raising from the region because all of a sudden the region is very exciting. Globally things are looking not so great, and then everyone has their eyes on the region and wants to raise from the region, but there's no foresight in that or strategy in that. And I think that's possibly the worst reason to do this, because you will end up having to rebrand or reposition as a company that's from our markets, and sometimes there is no viable business case to operate in our markets, or the market is too nascent for what you're doing. And we share this with the founder, but we've seen this before. And believe me, we've been pitched things that are so completely outside of our mandate that it's sometimes you almost wonder, if there's been any thought into sharing these opportunities. Now, on the other side of that, there's also founders who understand that, you know, there are specific market dynamics that they're looking for, and these market dynamics exist in Saudi, but they haven't yet expanded there because maybe they're not from Saudi, they don't live in the region yet, but they definitely, you know, are very bought into this. They want to, you know, they see themselves spending the next few years there, and that's when I say the next few years, it's probably at least, you know, 7 to 10. So it's a very big commitment. We like to see that there's been some investment done in the region, not investment as in financial. It could be financial, it could be something else, to test how this product works in the region. And how it needs to evolve to fit the region, because very often something that's built in, you know, even we've seen it in our portfolio where something that was built, for example, in Egypt, and successfully scaled to Saudi already, and that company's HomeSmart, by the way. They had to fine tune certain things in their model and certain things in ways in which, you know, they partnered with manufacturers and so on to adapt to the way the Saudi market works. So we need to see that there's a path to understanding that, or a clear understanding of that. So often it is the case where if I would say we've not invested in a company, or I can't think of a company we've invested in that said, oh, I'm you know, I'm somewhere else, but I'm you know, I don't know, in Estonia, but I'm coming to Saudi. Unless it's like a, you know, it's an absolute no-brainer, but it's very rare that it is. We've not really done it because we want to see that the work's been put in to understand how the market is different. And often you have to see it.
Yeah, quite clear. Thank you very much.
Thank you, Hidayat. Thank you, Stephanie. Guys, if you have any question, please go ahead.
Hello.
Hi, Wareed.
I think if I have a question, I can ask.
Yes, definitely.
Thank you, Stephanie.
Absolutely.
Very interesting and informative presentation. I wanted to ask your opinion on, at the beginning of the presentation, you mentioned about the micro M&A and how it's been always like a pattern of big competitor taking a small competitor that understand the space. How do you see this going forward in the future, like from now to the coming 10 years? Is it the same pattern? Are we seeing some changes in terms of the M&A outlook?
That's also a good question. So, you know, it could go two ways. I think in the past, that's most of what we saw. I think today, there's two things that are happening. Actually, this is Hidayat's question earlier. Companies are coming a little bit earlier. So I think our markets were maybe largely ignored in the past. And then, you know, very often we're not top of mind, right? I think now companies are starting to try and understand the market a little bit earlier, which could give them leverage, but that doesn't necessarily mean that they won't be acquisitive. I'll tell you this. So we have a solid network, I would say, of funds that are sometimes much bigger than ours, obviously, in terms of they've been in the business for a very long time. They're at their fourth fund. They also have a fund of fund program, and they're interested in investing in NUA's next fund very transparently, so that it's a strategy that some of these global players have, those that can actually invest in funds. Say, look, like I'll invest in 1 or 2 funds in the MENA so that I have a good view of their portfolio, because my startups that I've invested in through different funds are acquisitive. It's a good way to also get a scan of the market. So yeah, I do think that that's still very much a pattern that we can observe. But I also think it will be mixed. So it will not necessarily be 80% of what we're seeing, but it might be 55 or 60%, or maybe a little bit less of what we're seeing. And now we'll see a bit more listings. And then as there's more comfort in the ecosystem as a whole, I think there will be a ripple effect, because you can see a lot of value being created from the more there's listings and the more there's successful public listings. And people start seeing that, okay, I can find comfort in that, and Nofi, a lot of value that's being created. So you'll also have more private capital that will be acquisitive. So, you know, companies buying startups, but there's also a lot, by the way, of startups buying smaller startups. It's not as reported. There's also a lot of like old school businesses that are buying startups. It's not as reported. I don't know. We could debate the reasons, but who knows, right? I guess people like the typical, oh, you know, Uber acquired Careem, or Rasan went public, which is great. You know, I also understand the appeal of that.
Thank you, Stephanie. Wonder, Muhammad, guys, if you have any question, Hassan, Hamza, calling out
Hi.
names.
Hi. Thank you for your presentations and all the answers. My question is more technical. There's a lot of, I would say, rumors that when you raise in MENA region, it takes more to raise, like the period of time. And I understand that, for example, we already raised the seed a year ago, and it was easier and faster, like in the months, because there was not a lot of revenue to like check and everything else. What is the process when you already like have soft agreements to invest, and between that period when you give a soft commitment, and how long does it take the due diligence side and actually like the money transfer on the account?
So good point on how much there is to diligence. Obviously, depending on the stage, there's more effectively to chew on and unpack, right? So for us, like a pre-B or a Series B round would take maybe a couple of months from like end to end. Due diligence, going back, negotiations, because you know, after even it passes IC, you also have the legal negotiations, making sure that everything's completely tight, and then disbursement. For a very early stage, so pre-seed to seed, I would say 3 to 6 weeks. So we could be, so for us, and I'll tell you this very transparently, we've worked really hard on trying on having a process that's super seamless, which doesn't come without a price. And I'll tell you, it never gets easy to say no to a company, but we've become much better at saying no earlier, and at saying we're interested in learning more, share a data room earlier, and at not asking for a data room when we feel this is not for us and it's not going to be it's going to be a pass. So we don't want to waste anybody's time. And the reason why I say it comes at a cost is because I think everyone's so used to things taking time that sometimes people come back to us and say, hey, this is the quickest no I've ever received. You know, did you even look at my company? And the answer is yes, we have, but and we try to be as transparent as possible and say, look, and here's why we think this is not for us now. We might not be the best investors for you now, or we have some concerns over the model, and we try to share feedback when we can. And other VCs, I have to say, also have become faster. I think as there's more talent in the ecosystem, there's, you know, the VC teams will always be small and nimble, but there's more of a process that's institutionalized to make sure that you can go through these opportunities, still give them enough time to go through them, and then either pass or take it to the next step, you know, using an appropriate amount of time. The last thing you want to do is to have someone wait for very long when you without any interaction, right? Whether it's we want to know more, or this is not for us at the moment. So I think everyone's tried to streamline their process. Yes, there are periods though where things go slower. Obviously now things go quite slow, so now is a tough time to raise for sure. And then usually around the summer historically used to be tough because people try and disconnect, people travel, and both founders and investors really. But things used to come to a grinding stop before, and I think that stopped happening. So for us this summer, we didn't stop actually. We were leading around for one of our very mature portfolio companies, and we managed to close the round in 6 weeks, which was quite a big round to close. And I think this speaks also to the power of that brand and so on. So there's a few things I think that that you can do to make sure that your conversations are as effective or as productive as possible. So you also don't waste your time, which is make sure you have the material ready, make sure you have a data room that's clear and concise, your model is clear to understand. And also what I think, and I'd love to see more of is make sure you also have done your research on the VC and that you can ask them your questions. It's not just a one-way interrogation. You also need to ask them questions to see if these guys are a fit for you.
Thank you.
Sure.
Thank you, Stephanie. Any questions?
If there are no questions, maybe there was one thing that I think I'd like to take from the question. So we covered a few now, but there's one thing I'd like to take from the set of questions you shared, because it came back, which is the difference between family offices and VCs. And I think for your stages, that's super relevant, if you don't mind. So what's the difference between raising from a family office and a VC? I think we can look at this in two ways. One is the process. So how's the process different? And the second one is the value. And I'll tell you this, it can look very similar and it can be completely different depending on how institutionalized the family office is. And when I say this, I mean, look, some family offices are at the stage where this is still first generation. It hasn't been split through the descendants, right, of the founders of the family office. And the decision is very much centralized. It's very much, let's say I'm running my family office. I like what Wujdan is building. I've met her. I think she's the right person to do this. It's interesting. The space is interesting and adjacent to where my business runs. I decide that I want to put $1 million in Wujdan's business. And then the more it gets institutionalized, where sometimes family offices, they have either internally from the family teams that are running a process. And sometimes it could be as simple as, let's say Wujdan and I are cousins and we run the family office and we just sit and have a conversation and decide, yeah, khalas, we'll invest in this business. And it's just a question of scheduling that meeting and going over the documents. Whereas the most institutionalized version could be, and typically you start seeing that between sometimes at second, but usually third to fourth generation, depending on the size of the family office, where they hire a team. And sometimes, and it's a mix, there's people from the family, and then there's people who are just like, this is their job. They've done this for their whole life. They have no emotional attachment to the capital. And there the process can be sometimes very similar to the process of a VC, where there's due diligence, there's a few other things, questions that they'll come back on. They might have like a specific checklist that they need to make sure checks out before they invest. They might have specific terms that they're comfortable with or that they're not comfortable with. And here's where you really need to make sure that you understand what the terms are comfortable either negotiating them on your own or at least at a high level, right? Or have someone who can really help you with this, right? And then disbursement, I would say, depending on the level of institutionalization, can take different amounts of time. But in our experience, again, from our investors who are family offices who co-invest with us, so they invest also directly in some of the deals we do. We've seen, so I have 3 types, I would say. I have one family who's just like, okay, like send me the material. I like it. I've been thinking about this. I think I want to, I'd like to inject this much in the business if there's enough allocation in the round. I have another scenario where it's quite institutionalized. There's a full team. They'll run their DD. And it still takes only a few weeks if it's a young enough business, and they'll invest. And I have another scenario where it takes a long time because they're also under a lot of pressure. They have a lot of, check boxes to tick. And but it's worth it because the ticket is sizable. And not just that, their value add is unbelievable. Their network, their name, they open doors, their team sits with the founders. So it's a number of things that you'll have to kind of, play around with.
Thank you, Stephanie. There is a question, I
I
believe,
think
from Raj.
Yeah. Can you share with
Yeah, hi,
us a
thank
new
you.
investment appetite on pre-seed? Sorry, I'm just going to address, I think Dr. Wadeed had a question super quickly. Look, there's no scientific formula. We've done pre-seed, we've done seed. Most of the times we've done pre-seed, to be very honest with you, is either we knew the founder, so we knew the value of their words, we knew their track record firsthand, right? Because we've seen them execute before. And we also did reference checks. So it's a constellation of things. Typically, we like to see that there's some traction in a business, and that at least you can prove that there's, to put it like the most simply possible, you know what you need to be selling. Because there's two things that play into it. You'll come in thinking, this is what I need to build. But when you throw it out to the market, and if you're listening quite well, you'll see that the market sometimes comes back with, yes, but there's a few other things that need to happen, or actually, this is what you need to build. I'll give you an example. I don't know if a lot of people know this, but Kareem, when they initially launched, it was actually not a B2C. It was meant to be B2B for the workforce. And then when they tested it, they figured out that actually the real opportunity is in doing what Uber's doing, but not in the same way, because not everyone's going to take their car and decide to drive, but to open it up to B2C. So you have to also be listening to what the market's telling you, and we look for that in a founder. And at the very early stages, it's very hard because sometimes we don't really know the founder, so we spend a lot of time with them. We do reference check, we check what they've done in the past. Sorry, Raj, you also had a question.
Yeah, thank you, Stephanie. Just going back to the family office aspect again, there's an additional nuance to that we're seeing, which is what I call the family group, right? So it's still a family-run business, but they're often investing very, very sort of personally and emotionally into certain companies and startups, and often there's a link between what that startup is doing versus their own business as well. And we're kind of hearing a 50-50 kind of opinions around that kind of investor, because the kind of the downside to that is that that investor ultimately just wants to acquire you, right? And they want to acquire you on the cheap, and they're going to kind of almost not quite predatory, but there's a certain kind of behavior there that comes from that kind of investor versus what you think is more of a institutionalized family office that takes a more of an investor view and a kind of more of a return to the broader family LP, as it were, kind of view. So what's your experience of that, and have you seen what sort of stories have you heard about those kind of family investors?
So we have, actually. Unfortunately, that also exists. I think, is it the intention to actually, behave in this certain way? I think often not. Often it's just a lack of, being properly exposed to the ecosystem and how things work, because they end up sometimes taking such a big chunk of around thinking, okay, I want to own this much because I want to have a say, and then I'll never double down. But I'm a big investor. I don't want to sell secondaries. And it's just, it's unfortunate, but I think it's one of those negatives of still being in the teething phase of having new types of investors invest in this asset class. Now, to your question, I think, look, often there's actually a positive scenario of having them invest when there's an adjacency between what you do and what they do, with a long-termist view of, you know what, we like this business, we want to stay close to Raj, and then maybe in a few years we'll actually acquire it. Where it can get a little bit dicey is if they're your biggest customer and your investor, and you say no to the sell, and they'll tell you, well, then, we're pulling out, we're not going to use you anymore, who else is going to use you? So you have to be very smart about that. In the same vein as they do diligence your business, you need to do diligence your investors and see who else they've invested in. And obviously, it is a sensitive space. So I think it's much easier to come to a VC and tell me, hey, Stephanie, like, can I speak to, two of your portfolio founders? And I'll be happy to do that, because I think, that's part of the industry, right? It's the name of the game. I'll also speak to people you've worked with, and I think that's normal. We don't know one another, and yet we're about to enter in at least a 7-year-long partnership. It's a bit harder if you go to a family office, particularly those that are yet to institutionalize and say, can I speak to your other portfolio founders? Often there's no other portfolio founders. Often it's a very different type of business, or it's a business they've quote unquote venture built, but the old school way, where they've seeded it, they had someone come and run it, and then they've built it. But there's still a lot of space to build comfort with the teams that you're raising from. There's also some parameters that you can put in place, and when you're raising from them, to make sure that you're not giving away too much of the business, to make sure that and here's where cap table construction becomes quite important. And I think there was a question on that there. How can a founder mess up cap tables? I think by and large it's usually something you can salvage if you've raised a little bit from here and there very, very early on. But there's two ways. I think when you raise, you need to think of raising from capital that can scale with you, so that can follow on if they want to and if they believe in the business in your subsequent rounds, because that's a good sign for you. Sometimes you won't want them to, because it's I'm trying to find the best way to say it, but they're super early stage investors, and they've reached their return profile. When they came in your business, it was valued at a certain valuation. Then at your like 2 rounds later, this is what the returns profile is. They think it makes sense for them to exit now, and you want to sell to, because you want to bring in, I don't know, GA into your business, inshallah, right? So so there's that. But in a scenario where you want to raise follow on, you want to make sure that some of your VCs are following on in your business. The other one is, often you might end up with a group of a lot of small investors that you want to clean up. Why? For the same reasons as the secondaries market here will heat up later. We're starting to see it, at around pre B2B as well. Is you don't want to have to go to, Stephanie and Wujdan and Maryam and Haytham, who each initially put like very small tickets to say, please, can you sell your shares, because I need to free up $2 million for GA somewhere. So you want to make it easier to scale. Now, that's kind of structurally. More importantly, you will sometimes have to, bring in smaller tickets, because you think that, what, like Wujdan is actually, I want to be able to pick her brain on specific things. She comes from that space. She understands it like nobody's business. And you'll make space for that. And that's fine, right? Because early investors, sometimes angels, and even sometimes your very early VCs can help you a lot, right? They'll spend a lot of time with you if they see that you're also putting in as twice the amount of work, right, to make this work. But they'll also be your brand ambassadors. They'll help you raise. They'll open doors. They'll do all that stuff. So it's a bit of both, VCs is the same. So as you grow, you may also want to look at their portfolio and see, look, I want to raise from I don't know, I want to raise from NUA, because I can see that they understand omni-channel and direct to consumer, or they've successfully supported and helped a number of their businesses. And I'm not trying to like drink NUA's Kool-Aid, but I'm just trying to give examples, right? Like they've helped maybe their portfolio scale from different markets to KSA. Oh, مثلا, I don't want to raise from NUA because I'm not really sure that they really understand Web3. Fair, you might focus on a different set of VCs for that.
Thank you, Stephanie. I feel.
Thank you.
Yeah, go ahead.
Yeah, sorry. Thank you, Stephanie, for all those informations. Out of the risk of sounding too bold, is it possible to have like meetings with you out of these calls to like discuss our business and see your feedback as a Taqadam company who is interested in Nawa Capital?
I
So
mean,
actually,
I
Yeah.
love people being
Yeah.
bold. I'll leave it to Wijdan.
so thank you, Hidayat. Inshallah, Stephanie will join us in the investor showcase in Taqaddam in person. So you will get the chance to meet her in person and have like a quick chat with her.
Very good. Then you'll see my co-founder, inshallah.